Hey, welcome to Earning and Spending Part 2. What's going on here? We're going to look at some jobs that involve commission selling, like by phone up here, or selling a car, selling a house. And often the salesperson will get a commission, a percentage of the value of what they sell. Then we're going to also look at what the government offers in terms of allowances to do study, a youth allowance, a New Start allowance, and then what about putting some money away for superannuation for retirement? So it's not just coming in, we have to also maybe look at investing for the future. What's this over here? Well, you could invest in the stock market and see if your money grows and earn some income from that as well. So there's quite a few things now, apart from just getting that dollar coming in. We've got to look at tax and all sorts of things. So let's get going and have a look at that first topic then, which is commission. Okay, so come on down here, and here's the definition of commission. It's a form of earning, so yeah, money's coming in, you're earning money, where the employee is paid a certain percentage or amount based on what they have sold. Now, I'd write that definition down, a percentage or amount based on what they have sold. Okay, so it's generally, a commission is for people selling, obviously, real estate or cars, and you can be wholly paid on a commission basis, and that is if you don't sell anything, you don't get any money at all. But it's more common to have a flat salary, that is something coming in, and that's called a retainer plus commission. Often though then, if you get paid a retainer, you actually have to sell over a certain limit to then get a commission. We'll talk about that later on. Right, and that retainer is fair, isn't it? Because let's say the business isn't doing very well, they're not advertising much, you might not get many opportunities to sell, and then you would have not much money at all. So you've still got your retainer to retain your services for the company. All right, let's go and look at doing some problems, some simple problems on this one then. Here we go. Elaine is paid a retainer of $300 a week, plus a commission of 4% of her sales. Okay, during June she makes sales worth $54,500. Calculate her total pay. Okay, so let's have a look for the month of June. Okay, $300 a week, and we want a monthly amount, so $300 a week times 52 is all the weeks in the year, and then divide by 12 because it's a month. Okay, 12 months. So we want June, which is 1/12 of that. So don't forget to do that. You can't say June is 4 weeks. Right? Remember that. You can't say June is 4 lots of 300. You have to take it for 52 weeks and then divide by 12. Okay, so she's going to get $1,300 in June, and then she will make 4% of $54,500. And 4%, do you remember how to work that out? You multiply by 4, divide by 100. 4%, per centum, from Latin. 4 out of every 100. Or you could just say 4%, 4 divided by 100 is always 0.04. Okay, and treat the percentage as a decimal. So you would then get that amount, and the total of those two would be $34.80. Okay, so that's what she would make in June. Now here we've got the comment I made before. Commission is sometimes only paid if the sales exceed a certain amount. So you get your retainer, and then you might get, let's say, 5% on all sales over $5,000 a week. Okay, and so the commission would then be, if you made $6,500 in sales, then you get, that's a $1,500 over 5,000, over 5,000, and you would be getting 5% on that. So sometimes there's that sort of deal. Because you're getting a retainer, they want you to have a base sales rate anyway, and then anything over that, you get the extra. All right, are you ready? Come down and have a go down here. And we've got 4 little questions here, and we'll just see if we can get them all on the page together. There we are, yes. Okay, you might have to scroll back and look at the setting out. You need to have clear setting out so you can work through the problem. All right, have a go. I'll show you the answers down below now. There are the answers. All right, let's go on. Oh, here we go. This is what I was mentioning before. We've just not got money coming in. There are deductions. Okay, so let's look at the terminology. The total amount that is paid is referred to as the gross pay, the overall pay. Okay, that's the total that you've earned during the period. However, will you actually receive that? No, because deductions have to be made. Okay, and that's called the net pay or take-home pay. Okay, it's like going fishing, if you like. How much do you end up in your net to take home? Okay, so that's one way of remembering it. So the net pay is the gross pay minus the deductions. Now, what sort of deductions do you have taken out? Only one you have to take out, and that's taxation. Now, we'll be talking about taxation a bit later on. But tax, of course, is paid by all wage earners to help the country run, to build roads and so on. So we all pay according to how much we earn. If you earn more, you are deemed to be able to support the country more, and you will pay more tax. So there it is. Pay as you go. That's what it is. Pay as you go. Tax. Union fees if you belong to a union. Private medical insurance if you've taken that out. Superannuation. There is a compulsory part of superannuation that's paid by the employer. Its current rate is about 9%. So he or she will pay you for your work, and then they have to pay into super 9%. Okay, and that goes into a fund that you can access in retirement. You might be a social club, or you might ask them to take out savings and put it into your account. Okay, so the only one that you have to do here is pay as you go. The employer has to pay super, but that's not actually out of your earnings. That's in addition to your earnings, 9%. We'll look at that. Okay, come on down and let's go through them. Okay, you have to pay as you go. You have to pay your tax for the period and not take it away and then pay it later because you might have spent it. A tax department always makes sure that they get theirs first so they can run the country. So the Australian Tax Office, okay, is paid by the employer each month for each employee, and it depends upon the employee's gross pay and the current tax rates. And this is in tax tables the ATO sends out to employers so they can deduct the correct amount of tax per period. Excuse me. So you'll be on a tax table, and we'll look at this again later, depending upon how much you earn. If you earn more, you will be paying more tax. Okay, superannuation. Okay, superannuation is the idea of where regular payments are placed into an investment fund, okay, by the employer, and that's running at about 9%, I think it says down here. It might be a bit more now. And the employee can also put a contribution for themselves in that fund. Okay, and the idea is to have something to retire on. Okay, so you can have a lump sum in the bank which you can live from, or you can keep it invested and take a weekly pension, or what's called an annuity. That is, you're paid out of your, when you retire, you're paid out from your investment fund a certain amount per week to live on, like a pay, but that's then called a pension or an annuity. when it's still getting interest and it's paying you a bit at the same time. Okay, so here let's have a look at this 9%. So employee earns $600 in the week. The employer by law has to contribute a further 9%. With 9% of 600, do it on the calculator, 600 times 0.09 is $54. Okay. Some employees will also make a voluntary contribution to the fund, so that it grows into a larger amount, ready for retirement. Okay, let's have a look at union fees, and this depends on whether you've joined a union. Many employees belong to a union. Okay, and then union membership. To belong to a union, you've got the people in the union working for you, protecting your rights, so that's going to cost. So you have a membership fee, and that may be deducted from the pay each period. Quite often now, these deductions are left to the individual, except for the compulsory ones, because there's so much work in drawing up pays in a business. If you've got everybody doing various little deductions, it's a lot of work. So sometimes you have to organise that for yourself. Okay, the employer might deduct that and pay it into the union, and the union fees vary, of course, depends on the union, and they're tax deductible. So come tax time, you can say, well, that wasn't really earnings because I was in a union, and that's allowed to be a tax deduction, as if I didn't earn that money. As part of my position, I suppose. You decide to be a union member or not. Okay, private medical insurance. That Medicare covers everybody in the population at a base rate, but if you want to have better cover, right, cover for ambulance and hospital and things like that, you have to take out private medical insurance. Okay, and sometimes employers, the bosses, will deduct that from your pay if you want it. But you see, there's a lot of work, isn't it? If every individual wants different private medical insurance, different union fees taken out, it's too much work for the employer to do. Okay, so all of these arrangements here have to be paid, have to be arranged to put it into the private health fund of the employee's choice. All right, you may have a look at these websites, various private health insurers, to see how that works, what the rates are like, how much you have to pay per month for cover. All right, social club, voluntary savings. Okay, so social club, often the employees pay indirectly after they get their money, but sometimes the employer or business will deduct it. If you want to be a member of the social club, they'll take it out of your pay before you get it. Okay, and then that helps to pay for various social functions. If everybody pays into the social club, they've got money which they can run parties and so on. And here we are, voluntary savings. You may take out a certain amount and put it into a selected bank account. Okay, and that saves the people the effort and also willpower, because what if you get that money and then you don't put it in the bank, you spend it. So by taking it out before you get your money and having the employer put it into an account means you're going to have it in the bank and you're not going to spend it. Okay, all right, a lot of that is not relevant now because employers would have so much work to do that for every individual employee. Okay, let's have a look at a scenario though where we are getting the employer to take all this out. So here we are, we want the net monthly pay. What are you going to get for the month in your net? What are you going to take home? There's gross pay, the overall you've earned is $2,900 a month. So you're not going to do the tax tables, we're going to be told that that's a deduction in tax. Union fees are $216 per annum, PA, per annum, or annum comes from the Latin meaning per year. Voluntary superannuation of 7% is deducted. And private medical insurance is $51.50 a month. Social club, $72, what's this, per annum. Voluntary savings of $100 a month. Oh boy. So the pay office has a lot of calculation to do for this employee. Okay, so there's the amount that they've earned. Now we must do pay-as-you-go tax, $463.50 from the tax tables, which we'll look at later. Union fees, remember this was per annum, so divide by 12 months in a year. Superannuation, the person has decided to contribute some themselves, so 7%. Medical insurance was $51.50 a month. Social club, this was per annum, $72 a year at $6 a month. And then voluntary savings, $100 a month. Okay, so if you total all of that coming out, and that's what the bracket is for, when something is being deducted or removed from an account, you often put a bracket around it. So there's no bracket here. This is incoming, and your outgoings are sometimes just put with a bracket around it. So we're actually going to take that away from here and get 2,058. So in that month, the person will actually take home $2,058. So see this organisation. This is very important that you go through from up here and underline the various amounts and then record them in a systematic way there. And state there's the gross, less the deductions, list them, put a bracket there and then the answer. Are you ready? Let's have a go at some of these. Alright, so here are a few in 1A6. It's question 1, 2 and 3. Pause the presentation and have a go. And question 4 and 5. Now I don't know whether you know much about spreadsheets here. Set up a spreadsheet. Okay. Excel is one type of spreadsheet where you actually can do various calculations in the columns or connecting the columns of figures that you've got, and you might have a look at setting that up, because what that means then is for various people down here, the spreadsheet will do the calculation. You type in the gross wage in the tax holes here and copy down, you would have a certain percentage rate for them, and so when you put this in, this comes up automatically. And then if they're in the union, you've got entries there, and then you'll have total deductions will be the sum of all of these. Do you know how to use a spreadsheet? You might have a discussion about that and see what's involved. And net wage would be, of course, this column minus this column. Okay, and you can get the spreadsheet to do it. And if you copy the formulas down, when you put a formula in there, you use equals, take the little square and copy down. What it means as you enter all these for these people, then this will come up automatically. That's the value of a spreadsheet. A spreadsheet is very valuable in repeated calculations where you're doing the same over and over again. Okay, and businesses will all use spreadsheets, so it's useful to understand how they work out. Although quite often that's set up by an IT person, and all you have to do is the data entry. The IT person puts in the formulas, and once you've filled all this in here, these will just pop up. The net wages will just come up in that last column. Alright, we'll see how you go. Let's look at the answers to these. Okay, there are the answers. Whether you use the spreadsheet or not, still check this last one here. Okay, let's go on and have a look at other income. Now, there's other ways of getting money. Okay, employment. a job is only one way of earning money. Many people choose to be self-employed and run their own business. Others rely on government support. They're studying, unemployed, or unable to work or retired. And then in addition, you, instead of putting money in the bank, you can invest in shares and you get a dividend. We'll talk about that in a minute. Or receive an income from super. You've got your investment made over many years of working, and as it gains interest, you draw on that, and there's an income coming in that way. Okay, let's have a look. A youth allowance. Now, they will give you an allowance, a youth allowance, if you're 16 to 24 and studying full-time, or 16 to 20 and looking for work full-time. Okay, so 24, they extended a bit because doing qualifications often takes longer than 20 years old. Okay. Now, payments, what you get depends on an income and assets test. What's an asset? It's what you own. So if you are a young person who happens to own a car and a house, or probably wouldn't own a house, then you probably won't get this full allowance. They're paid fortnightly, but you get enough to support you in studying or looking for work, so you're not going to starve in the meantime. This is called Social Security or welfare, and supplied by the government. Social Security payments are all this. Okay, we'll look at a few others in a minute. All right. So, if you are single with no children, because some people up to 24 might already be married and have children, and it depends on these conditions. All different. If you're at home, then obviously you don't have to pay rent. Like other people perhaps, you might have to pay board, but you're not renting the whole property, and so you'll get this amount. If you're away from home, this amount, because that's allowing you to pay some rent. Obviously you're having to pay for where you're living. Okay, so all different conditions down there. Look at it carefully. We're going to come back and use that to work out various people's allowances. And then there is a special rate for long-term unemployed or migrant English students coming over to do full-time study. So we have these conditions here. Okay, so it's a matter of finding what category a person is in as to how they will earn, and it does depend upon whether you have any other income and what you own, whether you actually need this support, in other words. Let's have a look at the next one. New Start allowance. Now, New Start is for people over 21, so you're not a youth anymore, but under pension age. So you can't get the age pension. You can get that once you are, I think it's now 67 if you're a male, 65 if it's a female. So anyway, if you're age 21 and unemployed, New Start is to give you a new start. It may be paid while you're looking for work. Again, it depends. Have you got income and assets? Are you well off and don't really need the support? Remember, the income is any other money coming in, and assets are things that you own. Okay, and so they look at you and say, well, do you really need this? Okay, and here are the rates: single, 21 or over, no children, with children, etc. Okay, and if you've got a partner, you get that amount per fortnight each. Okay, so you don't get the full amount doubled. Okay, because two can live cheaper. Two people together can live more cheaply than two separate, because you'd share the rent and so on. All right, let's have a look at the off-study payment. These are all different government benefits, or social security or welfare payments to help people survive. So if you're over 25 and studying full-time, how are you going to live? You might get a part-time job, but you can't get too many of those because you've got to study. If you're out working all the time, you're not going to do well in your study. Okay, so the idea of Austudy is to help you live while you're studying. Again, same thing. Income and assets test, and it's paid fortnightly. Here again is the range of options here for different people in different situations. Okay, this is over 25. Under 25, the youth allowances cover you. All right, let's go on. Age pension. Age pension paid to people who have reached retirement age and to make sure they can live, adequate income, and this is provided for because you pay tax all through your life, and therefore you'll get some benefit at the end to help you survive. Retirement age for men is 65. I think that's 67 now, and 65 for women. And I think they've done it 2013, 2014, somewhere around there. The ages are going to be 67 next, I think. I'm not sure. As usual, payments are subject to income and assets test. I think you're allowed to own a home and have a certain amount in the bank and still get the pension or part of a pension. You might only get some benefits. Okay, again, single people, 525, and couple, 2 lots of 438.50. So it's not double the single rate. Again, because you're sharing. If you're a couple, you're sharing a house or something, so you haven't got twice the single expenditure. All right. Well, there's a lot there, isn't there? Let's go down and see if we can do some calculation. So here are 4 problems. Now you're going to have to scroll back and look at what category each of the people are under. Now, Matt is 17, studying full-time and living away from home. Okay, find what group he's in. Is he New Start? Is he a pension? Is he Austudy? Or is he a youth allowance? Okay, go and find the right one by scrolling back, and also what he's going to get. And Heather is 31, okay, single with 1 child, looking for work. What social security section does she come under? Okay. All right. There we have the 4 scenarios. I want you to categorise them. Find the correct benefit for them. Benefit table. And do the calculation of what they will get. Okay, let's have a look at the answers. Here they are. All right. Have a go. Right, let's go on. What other things? See, it's surprising, isn't it? When you say spending and earning and spending, you think of earning mainly as a wage or something coming in. We find there's lots of other things that are available to people to help them live. Okay, so part owners of companies, you can buy shares in a company. Why do they do that? Well, the company offers shares so they can get more money in to do extensions, maybe to enlarge. So they call for investors. Now, those investors are buying shares so that they will get a better return, perhaps, than just putting in the money in the bank. If the company grows rapidly and makes a lot of profit, it may pay shareholders a dividend at the end of the year. Dividend is a percentage in cents per share to share the profits with the shareholders. Okay, the dividend per share can be used to calculate the total dividend paid to each shareholder. So they'll offer so many cents a share, you multiply by the number of shares you've got, and that will give you the amount of income. So the dividend paid is the number of shares times the dividend per share. Okay, and that's another income. So you've got the investment in there, the actual total value of the shares, and then you're not going to sell them perhaps at the moment. If you did, you'd get a bigger income. If you sold the shares, you're going to keep the shares in there and just collect your reward, your dividend, your share of the company profits. That's the idea. Okay, and often this will be more than the interest rate paid by the bank. But again, it could be less if the company doesn't do well. All right, so shares are a bit more of a risky business. We call it a portfolio because often you've got a mixture of shares in different companies. Okay, so that's your share portfolio. Now, it's like a book full of different shares, if you like, and that's the language used. Let's have a look at doing some calculation with that. Okay, well, here we are. Don owns 15,000 shares in Adelaide Bank and 20,000 shares in Telstra. Calculate his total income from investment if Adelaide Bank, watch it, 32 cents a share, and Telstra pays 43 cents a share. Now keep in mind though, they don't have to declare a dividend. If things have been a bit tough, you might not get any return at all, or very little return on your shares. Okay, now let's do it in two parts again. We've underlined Adelaide Bank, so how many has he got? 15,000, and they're paying 0.32, 32 cents, $0.32, 32 cents there. Multiply it, 4,800, and then the Telstra shares, 20,000, paying 43 cents is 88,600. So total return there is that. Now, this would be coming in at the end of the financial year, so this would have to be income added to any wages earned, and you would have to pay tax on that. So at the end of the financial year, tax is paid. You can't pay it as you go because you don't know what the dividend is going to be. The dividend will be declared at the end of the year, and it has to go into the return for that year, the tax return. So actually you're paying that tax later, not as you go, because you don't know how much you're going to earn on. Okay, let's have a look at doing some. Here we are, just three little problems. So just make sure you look at it carefully. You know, you do this one and get a return, this one and this one. Okay, right, there's a little bit of a twisty one there. Chris wants to generate an annual income of 32,000. How many Argo shares would he need to purchase if they pay 17 cents a share? So it's finding out how many 17 centses there are in 32,000. I'll leave you to work that out. Alright, here's another one the same here. Okay, so a little tricky business there. Alright, have a go. I'll show you the answers now. Okay, there we are. Might have to put your thinking cap on for number 2 and 3 where it's working backwards. Okay. Alright, let's go on and look at the final one now, and that's very important, the superannuation. Now, if when you retire you only get the age pension, you might not have a very high standard of living. It isn't very much a week, is it? What was it? For a single person, about 500 a fortnight, 250 a week, and for a couple, 2 lots of 400 or something like that. And so you are going to put money into savings, which will pay interest, and you actually aren't allowed to draw on it until you retire. This is called superannuation. You might put in some. The legislation ensures that minimum levels are made to superannuation by employers. So it's part of your employment package, and that goes in and you can't touch it. 9% of what you have earned is in addition paid into a super fund. And employers are not allowed to spend that until they reach retirement age. Okay, so they make sure that everybody's got something. Okay. Now, they reckon that this is going to go up to 15% of salaries. Or would need to be 15% for 40 years to give a retirement income of 66% of your salary. In other words, you have to put a lot in if you're going to keep any reasonable level compared to your current salary. So you need to have a lot in there to gain interest, and to even have, that's 2/3 of your current salary. Okay, so this suggests that employees should be putting 6% of their income in themselves if they want just 2/3 of their salary effectively when they retire. Most people don't do that, and so when they retire, their standard of living will drop. They haven't got enough in the bank to return interest to live at the same level. Okay, when a person retires, usually around 60, that's a preservation age. That means you can access all the money. You can retire at 55, I think, and still access the super. When they retire, they may have a large amount of money saved in a super fund. Okay, and here we are. The following table gives projections based on salary increasing by 4% and an average crediting rate, interest earned, of 7%. We're trying to predict what you would be earning when you retire and what the interest would be that was being returned, and therefore how much money you should have in the bank to get a reasonable income, because your income will be that 7% of the total deposited over all those years in that account. Okay, let's have a look. These projections. Projected superannuation benefits table. So, let's take member 1. Salary at the moment is 50,000, age is 35. Contribution rate is just the basic, 9%. Retirement age 60. Projected retirement benefit 360,000. And multiple of salary, that's going to be 2.8 times the salary. That doesn't actually give you how much you're going to earn as such. Okay, this will be how much will be in the bank, projecting or predicting what interest is being paid all along the way. So it's going to grow to this amount with contributions and with the interest paid on that bank account. Person 2, 50,000, 35, and if they pay in 6% themselves plus a compulsory 9% this one had here, same retirement age, ooh, it's a lot more, isn't it? 4.7 times the salary, and you would be paid 7% per annum from this. Well, that would be the interest from that investment, and could you live on that? That's the question. Person 3, same amount, age 25, just a compulsory, retirement at 60. Because you've got 10 more years to put it in, it's grown a lot. Okay. And that multiple of salary looks wrong, doesn't it? Okay, the multiple of salary is wrong there, I think. Okay, because we've got the same multiple here. Alright, have a look at that later on. Let's have a look here. 50,000, 25, puts in 6% herself. 60, almost $1.5 million dollars there. 7.8 is the multiple of salary. Alright, so let's have a look at what we can do with that. Okay, benefits can be withdrawn from super funds tax-free after turning 60. If you try to access it before, it's actually not legal and you will be taxed. So when you retire, you can take it all out and start spending it, or leave it in there and let it earn interest and generate an income. That's what people generally would do, because you don't know how much longer you're going to live. You don't want to spend it all. Leave it in there and get income, which would be the interest paid on that investment. Okay, income streams are products that allow you to convert a pool of money into a series of payments, sometimes called an annuity. They pay a regular guaranteed income for a fixed term of between 2 and 20 years, with indexation often allowed. So in other words, if the cost of living goes up, the CPI, cost price index, goes up, then they will adjust that amount for your account as well. Okay, it depends on the arrangement of the investment. So these are invested to return money back out. Okay, so if you're self-funded retiree, that is, you've put enough aside in that fund to earn enough interest to live on it, you have security. You've got a regular income after they finish working for a living. Okay. So that's the idea, to plan for the future, not just for the 9% that the government says must be paid in by the employer, but add some yourself. And you can see up here, the ones with 15%, the people who've put in 6% themselves, are going to have significantly larger amounts on retirement. All right, we'll come back and we'll go down, and have a look at some problems. Okay, so you might have a look at that table and see if you can work out the differences. Okay, if you contribute 15% compared with 9% starting at age 25 and 35. Okay, so it's just going through the table which I mentioned before. Find out what is meant, and that's what I was saying up there by the phrase multiple of salary. Okay, benefit of that is considered 2.8 times. Calculate the assumed annual salary at age 60. So that leaves that problem with you. I said, we've got to check that later on. And here we have a problem which needs discussing, but I'll leave you to look at it and see if you can work out what it means. A benefit of this was considered to be 7.8 times annual salary. What's the assumed annual salary at age 60? Are you getting the idea? Okay, I'll leave you to work that out, and I'll show you the answers now, and then I'll catch you later on in the next part of earning and spending. But there we are, there's the answers. So I hope you are starting to see this earning and spending is quite complex. It's not just earning a wage from an hourly rate, is it? All right, we're going to do a lot more. It gets more interesting. So have fun with this. Be proud of where you're going. You're getting a lot learnt here, doing some good calculations. I'll catch you in the next presentation. Cheers for now.